Fuel Excise Tax Podcast, Episode 6.
We're talking about the ownership of fuel behind the rack, essentially, whenever you're dealing with the terminal bulk transfer system, pipelines, or refineries, vessels. You're talking about fuel behind the rack, and in order to evade, that's a bad word, to avoid having to pay the tax prematurely, one must be a position holder in a terminal or a throughputter in someplace other than a terminal, or you can be a throughputter in, I take that back, you can be a throughputter in a terminal also. But the key point is that you need to be a taxable fuel registrant, which is the 637S registration. I'm looking at our wonderful publication 510. I highly recommend this to anyone who's interested in excise tax. They have some interesting terms that everyone should understand. An enterer, I love those words. Enterer is the person who imports fuel into the United States, and this may be in the terminal bulk system or in something as simple as a highway transport vehicle. You are the person who is on the records for importation as the importer of record. The importer of record is the person who may not necessarily own the goods that are being imported, but the importer of record is the person who is responsible for the goods being imported. For example, if you go to FedEx or UPS or any other number of agencies, customs brokers will assist you in importing products into the United States. They will be the importer of record if you want them to be. If you want to be an importer of record, then you can register with the customs bureaus in the various countries you're dealing with, and then you can be responsible for the importation of the goods, because the goods usually will have some type of tax attached. For example, if I'm importing fuel into Canada, I'm responsible for the federal level goods and services tax and the excise tax on fuel if I'm importing fuel into Canada, which could be 11 cents a liter or 4 cents a liter depending on the type, and there's also some other rates that might apply. So importer of record has some responsibilities with it, and the enterer is the person who is responsible for the taxes. And there's special circumstances when dealing with the IRS. It makes you responsible for the tax. But if you're coming in through the terminal bulk system, it doesn't really change anything, because it's until you have it removed from the terminal bulk system that the tax will not apply.
Is the enterer also for importing between states, and how is domestic handled?
These are only IRS terms.
Oh, so it's only federal.
Only federal. And in this discussion, I'm starting with the federal first because it's the most universally applied, and everything we will discuss at the state level is viewed more in the terms of how does this vary from the standard set up by the federal government. More of a little cleanup on terms of bulk removal. You can have fuel leave a terminal and not have a taxable event. A bulk removal differs from a terminal removal in that a bulk removal means that you're exiting via the terminal bulk transfer system, which means it's either a pipeline or a vessel. So you could take 1 million gallons out of a terminal and put it into a vessel, ship it down the river to another city, and put it into a terminal in another city, which by definition, if you're receiving fuel from a vessel into large tanks, then you should be an IRS approved terminal. The
terminal bulk system seems a lot like just a giant bonded warehouse.
That's a pretty good description, I think. If I understand bonded warehouses,
Yeah, it's just until it's actually goes through customs and the taxes are paid and the tariffs or something like that. But it gets off the ship onto shore, but nobody can get at it until it's been inspected.
Well, and that segues into things like foreign trade zones. And foreign trade zones are interesting, and we'll cover that topic too.
These foreign trade zones are in America or in another country?
Foreign trade zone, as I'm using the term as it's defined in the United States, a entity, meaning a business or a governmental entity or someone, can designate a portion of property as being a foreign trade zone, and you have to register with I don't know the specifics on doing it beyond that it's registered with U.S. Customs, and products entering the foreign trade zone are deemed to be exported from the United States while they're in the foreign trade zone. And the advantage being is that you can manipulate them, change them, store them, do anything you want to them within the foreign trade zone, and then you can either ship them to another country without having them returned to the United States. They're treated as being exported without ever having returned to the United States, or you can return them to the United States and they'd be subject to whatever duties are applicable on it. For example, there are refineries that are in a foreign trade zone, and many times what the person wanting to set up the foreign trade zone operation will do is designate a certain portion of a manufacturing operation, like a refinery that has numerous cracking towers, may deem that, or may divide their refinery complex into a portion that is in the foreign trade zone and a portion that is not. So the crude oil going into the refinery would be diverted to the various cracking towers, and the cracking tower that is in the foreign trade zone could then export the fuel out of the United States without incurring the federal excise tax, because it's never really entered the United States to begin with. It's important to remember that the IRS likes to fit petroleum into taxable products, diesel or gasoline, and because the other products aren't taxable, like asphalt, I'm not aware of any excise tax on asphalt. Although it's a very valuable product, it isn't suitable for using in your car, obviously. And for that reason, there's no tax, so the IRS doesn't really care about asphalt. They do care about all of the products that go into making fuel. For example, butane and pentane, MTBE, triterymethylene ether, all of the ethers and toluene, and all the chemical byproducts and specific chemicals that go into making a finished product of gasoline, because raw gasoline does not burn properly in today's engines. They add additives, which...
Okay, so blend stock is all the things that go into a fuel.
Yes.
Okay, I was thinking it was like your base is your blend stock, then you add things to it, but that's not correct.
Correct. The base is the gasoline. So you have raw gasoline that is just the liquid that boils at specific temperature for gasoline, and then you add butane to make it more volatile. You add octane enhancers to reduce the flame rate. You add other lubricating properties or whatever desired characteristics to make it what it is, and all of these products are treated as part of gasoline. Anything that's considered a blend stock, which the IRS conveniently lists on a list of gasoline blend stocks, and they are considered to be as taxable as gasoline is. A question that some people ask is, what was the impetus for the movement of the point of taxation on jet fuel? And if everybody remembers, back in 2001, there was all aviation was ordered to ground within 3 hours of the incident, I believe. And so aircraft everywhere found the nearest airport and landed, and then did not fly again for several days. The interesting thing about the supply system for airports is that there is not, they try and keep the minimum amount of storage tanks as possible. So if they use 1 million gallons of fuel a day at JFK Airport, there may not be 1 million gallons of storage, or there may be 1 million gallons, but what you're not going to see is, you're not going to see 10 million gallons of storage if you have 1 million gallons of storage a day, or 1 million gallons of use a day, excuse me. The desire is to have the fuel constantly coming in from the pipeline so that you're accepting fuel on a regular basis and then using it as fast as you get it in, so you don't have a lot of inventory sitting on hand. If you remember our discussion on inventory, nobody likes to sit on inventory any longer than possible because you subject yourself to pricing risks. So just-in-time inventory is a desired result for airlines. If they could figure out a way to accept fuel and into the airport and put it directly on the plane, that would be the optimal solution. But they can't do that, so they do have to have a buffering system, and they have storage, but not nearly enough to accommodate a long period of usage of the aircraft. When 9/11 happened, the exact opposite happened. The pipeline system was set up to deliver fuel to various airports like JFK, like Hartsfield, Atlanta, major airports with huge quantities of fuel consumed, and the pipeline systems scheduled to deliver fuel into the terminals. Unfortunately, the terminals at the airports had not used up their fuel because the airplanes stopped flying, so they weren't pulling down the fuel out of the terminal storage, so this terminal storage had no room to accept anything off the pipeline. That creates a problem for the pipeline, because the pipeline is, I'm trying to think of a good analogy. A pipeline is a continual flow of fuel. In a perfect scenario, the pipeline would put in 1 slug of gasoline, 1 slug of diesel, 1 slug of jet fuel, 1 slug of kerosene, and send that down, and then each point would draw off their quantity and away it'd go. In reality, what you have is you have a slug of fuel that travels on the pipeline, and when it gets to a certain point, that is diverted into the storage system, and the rest of the pipeline shipment moves on. So you've got this one continuous slug, and you peel off the first chunk, and the rest of the slug moves up through the system. Because you can't stop the pipeline system, it can't stop the flow because it's a liquid and it won't compress. So the whole argument was that an example system could not accommodate.
Let's break there. Show notes and more info can be found at the Journal of Recreational Accounting.
That was in the
Google
system
knows where it is.
destined for these airports had nowhere to go. And an agent at the IRS argued that, Well, all this fuel was diverted into diesel because it had nowhere else to go. And since kerosene, and since we know from our previous discussions, kerosene is almost diesel with just a little bit of moving, somehow this fuel was diverted from the airports into a non-taxable use, is the IRS speculation. But you who have been listening to this series will realize that, yeah, you can just take the kerosene and dump it into your diesel tanks and then add the proper additives, and you're back to the state where you've got usable diesel. And since this all happens within the terminal bulk system, who cares whether it was taxed or not, because it's all non-taxable behind the rack where this mixing was going on. But the IRS was painting this picture as all these millions and millions of gallons of fuel that should have gone into the jet fuel system, and back in the good old days, jet fuel wasn't taxed. So theoretically, all this fuel was diverted out of the airports in a non-taxable basis and put into trucks on the highway on a non-taxable basis, and the IRS was screwed out of all this money. I think it's a failed theory, but it was good enough to convince the policyholders and the politicians, or good enough to convince the politicians that they deemed to change the law in 2005.
And what was the change?
That jet fuel would be taxable at the rack.
Oh, okay. So just to prevent this problem from happening again.
Right. So you had, in theory, you had non-taxable jet fuel traveling next to taxable diesel, and somehow because the non-taxable jet fuel was diverted away from the airports, somehow this created a great non-taxable quantity of fuel. But I think when you sit down and start penciling it out, it just doesn't make sense.
Oh, I see. So kerosene and diesel next to each other wouldn't make much transmix or anything like that, because they're almost the same.
Transmix is a good topic. When you have two fluids in the pipeline, there is going to be mixing in the interface, because they do not ship a plug between the two products. They just commence filling one product immediately after the preceding product. And there's a little bit of mixture, but when you're dealing with 100,000 barrel shipments, 200,000 barrels, million barrel shipments, the fact that you have a few hundred gallons or a few thousand gallons that is contaminated in the process in the interface between two products is immaterial. And that is siphoned off, and transmix but the IRS is eager about transmix, and they have deemed that transmix should be taxed at the rate for diesel, 24.4 cents a gallon. So an example. Cats, God. Eesh.
Let's break there. Show notes and more info can be found at the Journal of Recreational Accounting. Google knows where